talk about stocks. So we already talked about bonds, let's talk about stocks. So when we're having stocks, what's really happening is a firm is trying to gain money so that they could, you know, produce things. So basically, if a firm is like, hey, I really would like extra cash to create a new project, how can we do that? Well, we could do a bond, but when we do a bond, we have to pay interest on it. And so, what a corporation could do is say, well, let's sell stock. Let's sell some ownership of our corporation so that people will give us money so that we can make our project. So, a corporation is a business owned by shareholders. Okay. So, basically, what's happening here is that you are not giving up debt. So, you're not owing anybody money, but people are basically becoming a owner of the company. They're becoming a shareholder. Now, this could be private or public. We might not have publicly traded stock, but you could have what is called an IPO, an initial public offering. So this is where a firm finally becomes public. So basically, you had a private firm, and all of a sudden, you're really, really growing to where now you want to be um, trading your stock with the public. So this provides the funds to repay the early stage investors, the angel investors, things like that. Basically, you're going to get a lot of money because now you're having a lot more people wanting to invest in you. So when you buy a stock, this is a claim of ownership. Okay, you become a shareholder. You buy the stock to become a shareholder. Now, the company does have the option of paying you back dividends. So, a business does not have to pay you back. Okay, you own the stock, so you can do whatever you want with it. If you want to pay it back, cool. If you want to just keep having ownership in the company, you can do that too. Now, the company could pay you back dividends. Now, a dividend is going to be a direct payment to the shareholders. So basically, because you own this much stock, we're going to pay you 10 cents for every share that you have. Okay? So that's a dividend. All right? Basically, if you were to buy a stock for $10, this is a share. You buy it for $10, the company does not have to pay you back anything. Okay? Now, if the company becomes more valuable, this $10 could grow to $15. So that's where the investment part comes in, is that $10 will turn into 15, which could turn into 30. So that's where the investment part is, where you buy it at 10 and you sell it here for 15. Okay, you gain $5. Okay, that's your gain, $5. So now a company could pay a dividend. They could say, well, if you have a $10 here, we'll give you $1 per share per year. So for every year that you have this stock, you get $1. Now you can sell the stock. You could sell it at $15 if you wanted to, and then you get the dividends, and then you sell it. So then you get all those dividends plus the $15. Okay? So that's how investing in stocks works. The rate of return on a financial investment in a share of stock comes in the two forms. It comes in dividends or it comes in capital gains. Capital gains is that $5 that you earned because of the $10. Now, there are a number of different ways to measure the overall performance of the stock market. Because if the stock market's doing really, really, really well, then you're like, okay, well, I can earn more money by buying stock. So what we could do is we could look at the average stock prices for businesses just to get an idea on like how well the market's doing. And there are 4 examples here. There's the Dow Jones, which is the average of the 30 largest U.S. companies based on stock price. We could look at the Standard & Poor's 500. This is the same idea, but now we're looking at 500 of the largest companies. You could look at the Wilshire 5000, which tracks the stock prices of all the U.S. companies that have stock. Or you could look at the NASDAQ, which allows people to buy and sell from many physical locations. It has about 3,600 different companies. Okay, so these are the 4 different ways that people look at how the stock market is doing. If one of these are doing really well, the average company is doing well. Okay, so this is going to be a good indication if you want to buy now or sell. Because if the market's going down, right, then you're going to want to sell before your price goes too low. Now, in general, this is what the stock market looks like. Okay, it's going to go up and down throughout time. Stock prices have dramatically risen from the 1980s up to the 2000s. From the 2000s, which starts around here, to 2013, we really saw a drop in the stock price. Okay, and ever since the Great Recession, it's been kind of tough to basically just keep the stock market up. The rate of return over time will be high because the risk is high. So let's say, for instance, you bought a share of Netflix, and that peaked at $295 in 2011. And then 1 year later, it is now down to $53.91 per share. So basically, if you bought it at $295, okay, you owned $295 worth of Netflix. But because of the stock market, the value of that share is now $59. So on that one, you bought it for $259, and if you were to sell it, you could only sell it for $53. So that's a big loss there. That's a high risk right there. Now you could invest in something like Facebook, where it went from $40 per share in 2012, but then it grew to $212 in the year 2022. So if you bought it for $40, it's now worth $212. Okay, so that is a good investment. So it could go both ways, and stock prices change dramatically over time. Okay, you can also invest in a thing called a mutual fund. So a mutual fund is basically where it's a group of companies in one place, and so you can buy into that fund. So this is leading to a thing called diversification, where buying stocks or bonds from a wide range of companies to reduce the level of risk. So imagine you're buying stocks from only car companies. As soon as something happens with the car companies, you're going to lose all of your money. Okay, but if you were to invest in car companies and banks, or maybe you were to invest in some high-level companies that are not car companies, if the car companies goes down, you still have these other investments that you have which can help you out. So by diversifying your portfolio, like the things that you are investing in, you're investing in different areas of the economy, you can lower your risk. This is sometimes called don't put all eggs in one basket. Don't put your eggs in one basket. So you want to invest in different things. So a mutual fund is a great way to do that, because that is a fund that buys a range of stocks or bonds from different companies. Okay, so basically it's one place where you can actually do this, that has the different companies already laid out. An index fund is going to be a mutual fund that seeks to mimic the market's overall performance. So you can also buy the index, like you can buy into the NASDAQ. Okay, if you wanted to see the NASDAQ is doing really well, instead of buying each individual company, you could buy into the NASDAQ. And then when the NASDAQ is doing really well or really poorly, then you can look at how well you're doing. Mutual funds generally have a high rate of return over time. The risks are still high, but they do have a high liquidity. So something to consider. Okay. The last thing I want to talk to you about is equity. So the thing with equity is that this is the monetary value of the owner would have after selling the house or repaying an outstanding mortgage. Basically, what's happening with equity. And equity, a key word here with equity is your ownership. Okay, so basically, if you wanted to buy a house that's cost $200,000 and you had to put 5% down, so that's your money. So you put $10,000 down and you had to borrow $190,000. That $10,000 is yours, and you put that towards the house. That's your ownership going into the house. So if you were to sell the house right now for $200,000, equity is $10,000, and you have to pay off the $190,000 that you borrowed. Okay. Investment in a house is tangibly different from a bank account, stocks, or bonds because the house offers both financial and non-financial returns. Basically, part of your return on your investment happens from the consumption of just having a place to live, and you can also get that capital gain. So you buy it for $200,000, but then you could sell it for $400,000. So there's the investment there. Okay, and housing prices have generally gone up over time. Okay? So that is it for this chapter. I'll see you in the next one. Bye.